Andrew Colquhoun, Head of Asia Pacific Sovereign Research with Fitch, joins us now. Andrew, good to have you back on ET Now. Thank you for joining us. What do you make of the fresh uptick in the 10-year paper? When I say 10-year paper, the US 10-year paper. The US 10-year paper has moved dramatically with the assumption that US Fed will increase rates in the month of December.
Yeah, we expect the Fed to lift rates in December. I think the really interesting question, though, is what is the pace of rate increase after that? And the move in the 10-year that you speak to may reflect the beginnings of a change in mind in the market, that the pace of increase will be faster than had previously been thought. If I look at 2017, there's more than 100 basis points of difference between what the Fed tells us it's going to do with interest rates and what the market is currently pricing in.
The question is, even if that were to happen and the markets doesn't know how to price that in, what's the view post that? Will it be a more calibrated and a gradual increase? We work with an assumption that the first lift-off will happen in December.
We certainly do think that the Fed will move in December, and we're currently updating our global economic forecasts, which we do quarterly, and the next forecast will be out in December. But as of September, we were forecasting a more rapid pace of rate increase, Fed rate increase, than the market's pricing in, although not quite as rapid as the median of the dot plot that the FOMC has published. So I think that discrepancy between what the Fed is telling us it's going to do and what the market is currently pricing in is kind of interesting. And if things pan out in line with what the Fed is saying in terms of its expectations for the future path of rates, then that would be quite a shock, particularly in this region.
Andrew, what is it that the market is making of the dovish commentary from Mario Draghi? How has the street been reading into that?
I think that one of the key themes heading into the new year is divergence in monetary policy and the outlook for monetary policy between the Fed and the ECB and the Bank of Japan, on the other hand. So the governor of the Bank of Japan, some of his board members have made quite dovish speeches recently, and the market is expecting a further dose of quantitative easing from Japan in 2016. So that's something that seems to be playing into currencies.
What are your thoughts on the latest round of macro data which has come out from India? If I look at the latest batch of economic data, it is evident that inflation is making a comeback and growth is not back yet.
Well, we wouldn't put too much weight on 1 month's data. I think, certainly from our perspective as a rating agency, what's more important is the medium-term trend. And for India, we expect growth of about 7.5% this fiscal year, picking up to 8%. Obviously, if the higher frequency data are not performing over a period in line with those expectations, then forecasts can change. But at the moment, we're pretty confident that growth is heading in that kind of area. What we've also seen recently is further progress on structural reforms. So the government has liberalised FDI. For one measure, and there's also been a package of reforms on the electricity distribution companies. So structural reform continues to sort of chip away, and that's something else that should be growth positive over the medium term.
Andrew, good having you. Thanks so much for taking the time out and joining us and giving us that perspective. And you have a great weekend ahead.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.